You're listening to Inside Real Estate, your source for all things mortgage and real estate related. The show that brings you all the hottest topics and insights directly from those who know it most. Now sit back and enjoy the show.
Yeah, sit back, enjoy the show. Today, we don't have a guest. They backed out 15 minutes ago, so they are officially banned from the show. We're never going to have them on again. Banned. First banning. This is the second time we try to get him on, national guest, but, sometimes stuff happens. So today, we are going to be talking about mortgages. But for those of you that are tuning in, thank you very much for listening to the show. Obviously, we appreciate your support. Please like, subscribe, and follow us on whatever podcast app that you're listening to us on. You can also go to Facebook.com/IRE Podcast. You can go to YouTube, IRE Podcast. You can go to IREpodcast.com to listen to the show. And obviously hit that notification bell to make sure you don't miss an episode. But yeah, guys, it's me, Brad Weisgerber, Salvatore Cusmano. We are Inside Real Estate. And today, again, we are talking about mortgages. I've got some questions pulled up here that we want to answer. But first and foremost, boys, how you doing? You guys good?
Doing good, man.
Can't complain.
Yeah.
Doing real good.
All right. So what I want to do is our last episode with Mortgage Talk really went well. So a lot of people kind of felt good about it. We've got some more questions here today, and I want to run through them and maybe get some good answers. We'll make it a quick show today. We'll do it a half-hour little segment on mortgages. But first and foremost, let's start with the first question. How do you calculate my mortgage payment? A lot of people, they'll go on Zillow. They'll go on a mortgage calculator and kind of figure out their payment, but that doesn't always speak to exactly the full payment, right, Sal? A lot of times you're going to have, taxes, insurance, et cetera, going into the payment. What should a buyer look out for when they're figuring out their payment? Any of you? We were both one of you.
So I think it depends, right? It is. So, I think it depends on a lot of factors, right? What type of loan you're approved for, right? And I think that's why it's important you talk to someone who knows what they're talking about, right? Because there are some quote unquote hidden costs that you might not think about off the bat, like PMI, right? And PMI varies greatly depending on how much you put down, what your credit score is, what type of loan
and lender to lender,
right?
really, right, Sal?
Even with conventional PMI, there's different rates per each lender. So with that being said, a lot of times people will calculate payments, but they won't factor in that $150, $200 a month for PMI putting down and what their score is. And, that's a pretty terrible surprise. But if you're putting down 20%, it's not incredibly hard to calculate your payment if you're on a conventional loan.
One thing I would tell
also a lot of people underestimate taxes and insurance. And
underestimate it, yes.
Yeah, underestimate. So they're always thinking, a lot of people think that, they're going to pay $100 a month in escrow for tax and insurance. That's not the case. Almost never is that the case. So people forget about that portion of their payment a lot, and almost I would say probably 80 to 90% of home buyers are escrowing because they're not putting enough down payment to waive the escrows. So that's a big portion of the payment that a lot of people overlook or don't think about it because it's not in front of their face every day.
What's the best way for a consumer to kind of figure that out? How do I figure out my payment if I go to a calculator and it's just giving me my mortgage payment and not, PMI and not my taxes and insurance? Is there a way for me to figure that out on my own?
Yeah, the best way for you to figure that out is to talk to a professional. You don't try to diagnose.
The best way to do it accurately.
Yeah. You're not a doctor. You're not going to try to perform surgery on yourself. So don't try to figure out your mortgage payment when you're not a mortgage professional. You can try to, but I wouldn't put a lot of faith in it because you don't do it every day. You're probably not going to do it right. And it's not going to be accurate. And you're going to be surprised when you talk to a real person that does it every day, what it actually is.
And it could affect your qualification, right? You might think you're qualified for a $400,000 house, but all of a sudden you buy a $400,000 house, you're looking at houses and the house is in Grosse Pointe in our area, for instance, it has really high taxes and all your taxes are $15K a year. now you're adding an extra $1,000, potentially $1,200 or $1,100 to your payment, and you might not qualify all of a sudden. So you've got to look. Right. It's tough to really narrow that down. It all depends on the property and how much the taxes are. It could be in a different spot that you might, like Hazel Park has really high taxes, right? But you might be looking at Oak Park, which is right next door, and the taxes are, instead of $5,000 a year, they're $3,000.
And I think one of the biggest misconceptions is that the payment that you get when you close a loan is going to be the payment forever, and that's just not the case. So, like in Michigan here locally, right? Like when we close on a home and we're doing the mortgage, we're qualifying off the current taxes. So someone could have bought that home in 1985 when the taxable value was much lower than it is in 2021, right? And that cap comes off as far as because once you buy a home, you're kind of locked into how much your taxable value can change year over year. So that when you first buy that home, that cap comes off and it gets reassessed at a higher value. And all of a sudden, the taxes on a $300,000 house that were $2,500 because the previous seller bought it in 1985 are now $6,000.
Right.
And you get a bill in the mail for $4,000 or $3,500 a difference, or an understanding that, hey, your mortgage payment's going to go up $600 a month until your escrow is figured out. So I think that's really what people need to account for on planning and budgeting and figuring things out, because like theoretically, if you include your taxes and insurance, your mortgage payment will never constantly stay the same for 30 years.
Your taxes will change. Your taxes, your insurance will change.
That's a great conversation to have that I feel like, and this is just a complete out of my ass number, but educated, I feel like 97% of loan officers do not talk about that and don't have that conversation and don't explain that's going to happen when they buy a house. They're always about getting
people are worried about sales.
They're just worried about the bottom line.
I don't want this person not to buy this $300K house or $400K. Right. They're thinking about a juicy loan and not like the fact that this person can't afford that or doesn't want to afford that.
Right.
So I think talking.
It's hard to do. It's hard as a loan officer to give that news to someone because again, it could jeopardize the deal. It could scare the buyer. So loan officers shy away from that stuff.
It's such backwards thinking because as a loan officer, you going above and beyond and explaining those things creates a bigger bond and more trust, and people buy off trust. Well, right. So when that borrower trusts you, they're going to refer everyone to you because you're super knowledgeable and they know it.
Right. If you have a big pipeline, it's the biggest pain in the ass a year later. Like talking, hey man, I got this escrow shortage. You're like, oh, and mind you, I think you learn this as you do mortgages, right? Like, oh shit, I didn't even know how that works, right? And eventually, it's a constant conversation that I have, right? Or even when people are refiing, they're like, man, my payment went up $400. I need to refi. I'm like, no, your taxes just went up. Like, you can't fix that with your mortgage.
Yeah. So bottom line, if you're a consumer, make sure you talk to a good loan officer in your area. And make sure that you're asking that question: will my payment go up? And a lot of times the answer is potentially, yeah. Potentially your payment's going to go up depending on what your taxes do and in what area you're in, right? Mm-hmm. So, all right. Next question is: what is the difference between a pre-approval and a pre-qualification? We get this a lot, right? And as a consumer, a lot of times you think you're pre-qualified, you're good. Oh, I'm good. I can go buy this house. But truthfully, Sal, if they haven't sent in any documentation and they're just going off their credit score, because a pre-qual, just so everybody knows, a loan officer looks at your information. You tell them verbally what you have as income and assets. They pull your credit, and that's really all they need to do a pre-qual. A pre-approval is where you get a full set of documents in from the borrower. They send in their pay stubs, their asset statements, and they're actually reviewed. It's a higher level of approval, right, Sal?
Yeah. I mean, like, for example, I had someone call me yesterday and he wanted a pre-qualification. And I just kind of told him like, hey, that's
Bush League.
Well, no, I just let him know like, yeah, I understand. But like in this market, that doesn't even matter. Like that's like not going to, you need a full pre-approval.
Especially in this market.
There might be another lender who will write him a quote unquote pre-approval, but like this particular client hadn't started his new job yet. So currently he's not working. And I'm like, I can't get you a pre-approval. And I don't think, and explaining it to him, he understood, but it's like, dude, if you go today to look at a house, like, and you told me you might not have that offer letter till the end of the month, we've got 2 weeks where we can't do anything. I can't submit a loan to underwriting with no income. They'll deny it. Right. So
you're not qualified right now.
Yeah.
Right?
So I could write a pre-qual based upon what you told me about your salary that you're going to receive and everything. You're going to be good. But that's all about I can say. And why the hell would I put that on paper?
Right.
But, a lot of people or companies, I should say, write pre-quals because they think it makes their client probably a little more sticky to them. Right. But in reality, it just,
you're doing the wrong thing.
It sets a client out. Yeah, I'm good to go. I don't think they even tell them, hey, man, just so you know, like when I pull your credit and get all your docs, if something's different, it could affect your approval and you might not actually be approved. Why not take that step? If you're out there looking at homes, right? Why would you not be ready to go? I mean, it's just a waste of time. It's a waste of everyone's time. So, that's the long and short of it. But basically, a pre-qual is what someone says, right? And someone like, I don't know, I'm sure everyone when they're applying for an auto loan or something where they don't ask for docs is like,
right.
I'm not self-employed. I'm W-2'd, man. I pay myself. And people tell me that all the time, right? Like clients will tell me and fill out an application that they're W-2'd, and then I see the W-2 came from their own company.
Or their own company.
And it's like, you're not W-2'd, you're self-employed. So I need this. We get those documents and
they have a loss.
Often it works out, but sometimes it doesn't work out, right? Mm-hmm. Or they haven't had any activity recently. So it's really complicated, and it's not because we want to be a pain in the ass. Like, I don't want to get and look at more documents. I got enough documents to look at.
Right.
It's just because we need to do our due diligence to ensure that if you're out there looking at 15 homes submitting 10 offers this weekend, which, maybe none of them will get accepted, that it wasn't just one big waste of time. I mean, it's crazy.
It is crazy, but it happens. But consumers and borrowers don't always know this stuff. They just, borrowers a lot of times, the first place they'll go is to look at the house. They want to buy the house, and they don't even think about the financing until after the fact.
Well, and another thing too is, people just like to take the path of least resistance. If you had 2 paths and both of these companies said they get you a pre-approval, but one of them wants documents, right? One of them says, I don't really care. I'll just get you the pre-approval. You know, I mean, as a consumer, which path are you going to take? But if someone explains like, dude, it's really not that hard to grab. Probably take you 5-10 minutes on your computer. It will save time later in the process and also give you peace of mind that you won't have any issues. It might change the way that client thinks, but even then people are probably like, fuck it, I want to go see the home. So hard to say.
And real estate agents sometimes push for it too. They're like, just give me a piece of paper. So we get pressure from not only the consumer, we also get pressure from the real estate agent to ship out this pre-approval so they can put on an offer. And sometimes we have to turn around and say, I don't have all the docs. You want to put in an offer, but we don't have an approval yet. And it's hard to say that because it is the right thing to say, but people are pressuring us as loan officers to give them that piece of paper so they can go in and put in an offer, especially in a market where it's really hot like right now. But I think good loan officers and smart consumers are going to take the time to get the right proper approval, especially in this market. It is funny to me how a lot of times, people start looking for houses because they're starting to look for houses. The first place they go is Zillow or Realtor.com, and they start looking at houses and they start falling in love with these houses before being pre-approved. I always thought it was kind of odd that you would go shopping for a house without having the money secured, right? And sometimes
it's ingrained in people, right? Because like when you go buy a car, what do? You don't sit at the finance desk first. That's the last thing you do,
right?
You test drive the car, you look at the car, right? Yep. You look at other cars. Yep. The last thing you do is sit at the finance desk.
Correct.
Yeah. Well, it's also a same day process typically, right?
Yeah.
No doc.
But more people buy cars more frequently than they buy homes. So that's like the process in their head when they do a major purchase. is I'm going to look at the shit first, and then I'm going to figure out.
Or people are like, I don't want to get my credit pulled unless I find the house.
That too, yeah.
But that's a question here.
It doesn't work like that, really.
So that's a great question. So one of the questions is, do I need to get my credit pulled, and will it hurt my credit? Right? Yes, and you're buying a house. You got to get your credit pulled. Is it going to hurt your credit? It is going to be a hard inquiry, but it is a mortgage inquiry. But it's necessary.
Going to affect your credit a couple points. It's not going to it's not going to drop your score from a 720 to a 680. Yeah, it'll be a couple points, and then you have 30 days. It's a mortgage inquiry, so you have 30 days after that first one to get your credit pulled by other mortgage companies without affecting it at all.
I think it's 14 days, just so you know.
Well,
I thought it was 30.
No,
that's the biggest unknown to me misconception as far as how many days you have. I don't know. I think it's when it cycles. It's probably up to 30 days, no less than 14. Yeah. So, the biggest issue, quote unquote, that I see with, it's like, listen, if you seriously want to buy a house and you're serious about it, you'll let me pull your credit because I need to. And all the time I pull credit and someone thinks they're 750 or 760 and they have a $30-$40 collection from previous this year and they're in the sixes,
670,
and it doesn't work. Yeah. I mean, last week it happened. Luckily we were able to get them to call. They got a deletion letter. We'll be able to rapid rescore that client now before they buy a house or during the process versus scrambling,
Yeah. So my credit card company said I have a 760 credit. Why is it so
question.
low?
Yeah,
or they'll say, instead of pulling credit, I'll send you my Credit Karma.
It's not the same model, people. Just so you know, Credit Karma is a different model.
Well, and they take, for example, like inquiries or
balances
credit, which isn't really as big of a deal on your actual FICO score.
Right.
A lot of people think their credit probably isn't ready because, Credit Karma has them 30, 40, 50 points lower than what they really are.
That's me. I have a high credit card balance and Credit Karma nails me on it. But when I pull my credit, I'm above 740, right? They're not as hard on that.
It's just different weights that they put on things. And, to me, and I don't mean to sound rude, but like, all right, like you've got my time and attention to help you out with this mortgage. If you aren't ready to get your credit pulled, you aren't ready to buy a house, and I don't have the time to help you. I have the time to maybe guide you if you think you have bad credit or something like that, but not if you're like, I've got great credit. I know I'll qualify, but I'm not ready to pull it. What's my rate?
You don't have time to dance and speculate. It's like wasting everyone's time.
You're just shopping everyone around, whatever. Just go with someone else. Like I'm here to help people, right? Not like, just what? I don't know. I guess that's a personal pet peeve, but at the same time, like, truthfully, how can you expect to get answers if people can't pull your credit? I mean,
you can't go to the doctor.
It's your financial story on paper.
Correct. It's the most important part of it all.
It's required. I mean, it's like, I want to get in the pool, but I'm not ready to, put my swimsuit on. What's it feel like? What's the temperature?
Sometimes swimsuit's optional.
Well, whatever, right? I mean, it's just like, okay, dude, like, I'm either going to push you in or don't get in, like it's just,
I liken it to like going to the doctor and then the doctor saying I need to take blood work to really figure out what's going on. And you're like, nah.
That's
right?
Like my blood's fine. I'm telling you, it's fine.
No, I need your blood to figure out exactly what's going on.
Yeah. I don't like needles.
Yeah. I don't like needles. I don't want to do that. Well, no, and I can't diagnose
Come back when you're ready. Yeah.
You know what I mean? I can't diagnose you.
That's a pretty good analogy, right? Like, we're going to,
it's impossible. You got to have that. So just for the consumers out there, just know that getting your credit pulled is part of the process.
And what I tell people all the time is I'll pull credit today. Someone won't find a home. And in 60 days or 90 days, right? And that's another question. How long is a pre-approval last? Depends on the lender, how long they'll take a credit report for. I mean, a lot can happen in 3 months or 2 months even. You could go out and get 4 more cars, like the reality is, from the lending standpoint, they want to make sure things are up to date, right? That's why we require pay stubs. When someone sends me a tax return from 2016, it's like, what are you doing? I mean, we need fresh documents and credit to look at. So I tell everyone 60 days really, and with that being said, when I usually re-pull that credit, unless you did something to hurt your credit, like open a new account or max out a credit card, your score will probably be the same, if not better. So
yeah, it's not going to get like crazy.
Yeah, it's fine, especially if you think you got really good credit. It's like, okay, so if you think you told me you got an 890 credit score, which doesn't exist, then you'll have an 888. Like,
yeah, everybody's always like, I've got.
I think it's like 890.
I got like an 8.5, man. I'm like really good. So like people think they know, and God bless them, people like consumers.
Well, I mean, you can't fault them. I mean, I think credit is one of the most miseducated. I mean, it's one of the most important things to a degree in your life, right?
Yep.
But you don't really learn about it in school.
No,
you don't learn about.
You can't learn about it as an adult. You don't have access to your own credit report.
I think
it's a complete racket. You have no idea what's on it.
It is a racket.
You have no idea what's on
trash. I think they need to do some reform.
And you can't fix it. Like it's
Well, it's like, oh, I had a 30-day past due on a Macy's card that was truly a mistake. Like,
right. And people were smashing my credit over it.
300, 400 grand in the bank had a late Macy's card and it smashes their credit. It's like there should be a better way to do this, and hopefully there is. And I think that's just something that happens when you offer something on such a massive scale. It's essentially every single person in the United States, unwillingly, right, has a credit score. Like, it's not like you can opt into it or opt out of it. I mean, you can opt out if you never open an account, right? But like even then, you can have a judgment or whatever it is, and it's like a record.
You got good credit, bad credit, or no credit. That's all you're gonna have.
It's tied to your social security number.
Yeah.
Which, so I think people need to think about it, but at the same time, like, I sure hope there's some reform because it's fucking trash.
They try to reform.
I can't stand when I see, what, dude? I had a collection for $30 from an old phone bill 5 years ago
or something. You know what I mean?
Yeah, like, it's like, and that's killing your credit. Like, they really need to take a look at that bullshit.
The worst is when you have a collection and it's because it's been so old, like nothing happens. But then you were taught to pay it off.
It's the worst thing you can do.
Listen to this, guys. Whoever's listening to this podcast right now. If you have an old collection and it hasn't been updated in years, and you go to update it, what happens is it updates the date on that collection that makes it more current. That actually ends up hurting your credit more.
Unless they agree to give you a deletion letter.
Yeah, but that's hard to get.
Don't just pay it off because, like you said, it's like taking a wound that's like scabbed and healed and just like taking sandpaper to it and ripping it back off.
Let it fall off. It's weird.
It updates that date, most recent activity on it, and it's a derogatory account that's like most recent, and it's going to destroy your score.
That's another misconception.
Even if you paid it off, because it's a derogatory account, recently active, it's going to destroy your score.
I mean, people just have to look, like, these companies, I feel like, have to look at things from a
who's these companies?
These
credit bureaus?
These bureaus, yeah. I mean, it's like, okay, you've got $300,000, $400,000 worth of credit balances between your mortgage, cars, whatever, and you had a $28 late Macy's bill. It should affect it like proportionately,
Yeah, like you've got 10 years of
time. You have late mortgage payments or car payments. Okay, that's understandable, right? But even then, it's like, dude, it was a mistake. I've been paying my car payment for the past 5 years on time. I had one late payment, right? Like there's no grace or whatever. It's like, or I pay it right away as soon as you call me, or I find out. Versus like, I mean, there's things that are trends, but like, should someone be so punished for having one mistake? I mean, it's fucking crazy. And it gives you like anxiety. Like if you got really good credit and that happens, like it will drive people nuts. Like I have clients who are like calling me every day, like, dude, I can't believe it. I'm like, sorry. Man. They don't care.
It's so fucked up because it affects you for 7 years. It stays on your credit for 7 years.
A mistake. A little mistake. Right.
Yeah.
Yeah. We're not talking foreclosure here. We're not talking repossession. We're talking about
a 30-day late payment.
Right? That gets
I forgot. I thought I had auto pay set up. I didn't. Whoops.
Right.
As soon as I got the notice, I paid it, but it was too late.
Yeah. All right. A few more minutes. I'll do a couple more questions, maybe one or two of them. So next question is, what kind of mortgage should I get? Which is really an interesting, like there are different types of mortgages. You've got FHA, you've got conventional, you've got VA, you've got rural development, you've got portfolio loans. And as a consumer, What's that?
Jumbo,
which are above the loan limits. So the question is, what is the best loan for me? And I don't think a consumer is going to know that unless they talk to a professional. You know what I mean? There's no way a consumer is going to be able to say, oh, I want an FHA loan, or I want a VA loan, or I want a USDA loan without really knowing what it takes to qualify for those and which one is the best one. We basically have to make that decision for them a lot of times.
Well, then we don't make the decision for them. We tell them what their options are and explain the nuances of each one, and they make the decision. But I feel like most consumers out there they just think, I want a 30-year conventional fixed.
Yep.
Because that's like the bread and butter, right? But that's not necessarily the best loan for you, right?
Yeah.
USDA
There's even ARM programs now that are really attractive with really good rates, right, Sal? I mean, I just closed a 5-year ARM at 1.99 for a client of ours. He knows he's not going to be in the house for more than 5 years. It's his plan, and he wanted the lowest rate.
Points, so, but
he did.
He did
pay
a lot
points
of
for
points.
Not smart, but
especially
I mean, it all depends, man. I mean, listen, you obviously take on a little risk with the ARM, but probably very little if you're going to be out of there. But there's lots of different loan programs, and I think if you have a good loan officer, they'll educate you or give you those options. But right now, with rates being so low, I think an ARM is dumb.
I agree.
Because you don't know what could happen. You might not be able to sell your house, right? Let's say you get a divorce or whatever, right? Or you need to...
You like the security of the 30-year because the rates
you want
to
rent it out. You want to rent it, whatever it is.
Yeah.
You're locked into that rate for the end of the term. So I think an ARM is kind of dumb because you never really know what will happen. And it's not a guarantee, but it's highly likely rates are going to be higher in 5 years. So why would you, take on that risk for an eighth of a point different in rate when you could hedge that in for 30 years and have a great rental or whatever it is, right? I mean, I think people really need to think about that. I don't like to even offer ARMs unless someone's got a definite plan, but I don't think anyone has a definite plan.
No.
I mean, when I was in college, I thought by now I'd have I'd be in my, corporate role with 2-3 kids running around and blah, blah, blah. A grown man.
Yeah.
I'm not. I feel like I'm the same, except I just got way more stress and that. But so things change, and I think that people really need to, get on board with, thinking that anything could happen. You know, and that with that being said, you should probably take the safest long-term bet.
Yeah. Last question we'll do is, when is the first mortgage payment due after I close?
So depends. So it's go ahead, Sal. You can answer.
Yeah, I mean, it depends, right? So let's say your closing date set for July 15th, right? So I think a big misconception is when you make your mortgage, and this is a good thing too, when you get a payoff. Why is, my balance says it's 285. Why is my payoff 286, 200, right?
Yep.
And that's because when you make your mortgage payment, you actually pay the previous month's interest.
That's accrued. Every day that you're in the house, interest accrues.
Yeah.
Right.
So at closing, in that example where let's say it's a purchase and you're closing July 15th, right? At closing, we're collecting 15 days of interest to get you through to August 1st. Your first payment is until September 1. And we are collecting the month of August's interest.
Correct.
At your September 1 payment.
Correct.
So when you make your October 1st payment, that's the month of September's interest, right? So you basically can't live a day with a mortgage without paying interest.
Correct.
So with that being said, if let's say you close July 2nd, right, you have the option to make your payment August 1st instead of September 1st. And in that case, we will actually credit you 2 days of interest, right?
At closing.
Correct.
But that's pretty rare. And I don't even really like to give that out. I mean, think about all the hectic things you have going on when you move into a home, right? And
all of a sudden you got a mortgage payment due right away. Whoa.
Yeah, you get and not to mention you got to set it up online or get stuff in the mail. Or blah,
so
blah,
although
blah.
your payment might not be for a month, Sal, what you're saying is, just to recap, you pay that interest regardless. You either pay it at the closing table or you pay it in your first payment. But regardless, you are always paying interest, and you're always paying it in the rears, meaning it's accruing. Like my mortgage interest is accruing today, and on the first of the next month or whatever.
The difference is if you're closing on a purchase, right?
Yeah.
Your cash flow is less out of pocket because you aren't paying that principal portion either.
That's it.
So
you're only paying the interest
from a money out of pocket standpoint. Yeah, skipping the payment will help you, like especially if things are tight, right?
Yeah.
Because while you're paying the interest, you aren't paying the principal.
Right. All right, man. Well, that's, I think, the last question we're going to do. I really appreciate
I got to run.
Yeah, I know you've got to run.
I got a doctor's appointment, so I'll see you boys.
All right, buddy.
Yep.
We'll talk to you.
Okay.
Yep. That was pretty good. I like doing those episodes where we talk about what some of our people are thinking. You know what I mean?
Yeah.
So for those of you that sat through and listened to our show, thank you for making it. And if you liked it, please like, share, subscribe it. If you didn't like it and you're still listening, go fuck yourself. Otherwise, find us anywhere you listen to your podcast app. You can go to, Stitcher. You can go to Spotify. You can go wherever Apple to listen to us. You can also go to Facebook.com/IRE podcast if you want to watch the video. Also on YouTube, you can find us there. Or you can go to IRE podcast. What?
You can tell Alexa to play it.
Oh, yeah. You can tell Alexa to play us Inside Real Estate. So thank you very much for all of you that have listened. Please like, subscribe, and if you will, please leave us a review. That really helps us out quite a bit. Thank you, everyone, for listening. A good review. Yeah, not a bad review.
If you're going to leave a bad review, go fuck yourself.
Go fuck yourself. Correct. All right. Have a wonderful week. We'll see you next week, everyone.